SoFi stock is now in a doom and gloom area now that the stock is below $5 a share, okay? Now this is a problem because Anthony Noto previously did a vote that would allow him to take for every 3 shares that you own to bring it down to 1 share and actually triple the cost of the price. This actually lowers the overall amount of outstanding shares, which should bump the stock being out of a penny stock, which should allow other investors to participate in buying the stock overall. But investors are worried that this sort of gives a stock a bad omen. And I mean, it is a little bit of a bad omen because every single bad company ever has always done a reverse stock split. But I'm here to calm some people's nerves because, like Warren Buffett says, we're buying companies and businesses, not stocks and tickers, right? This is a very big difference because one is one where you care about what other people are saying about the stock and you care about the price valuation, these sorts of things. The other one is caring about the true overall growth of the company and whether they're going to come out on top within the next 5 to 10 years. This is so important, guys, because you have to remember why stocks are even valued the way they are in the first place. Because although retail investors like you and I, we don't really see the revenues and profits of the company unless there's a dividend that's being given out. And so it's sort of intangible for us to get those sorts of benefits. But to large businesses and individuals like Elon Musk buying Twitter, those benefits can become very tangible if you put an offer to buy the entire company. Like for example, a JP Morgan could come in, buy up all the shares of the company, fire all the board of directors, all the employees, get rid of the CEO, and take care of all the 4 million, users that SoFi has, take over Galileo, take over Technesis, and everything that comes along with it. Their tangible assets, their liabilities, and all that, which are very, very real fundamentals of the business. Now, there's always buying pressure from retail investors and institutions that might want to buy a fractional part of this company to say, hey, you know what, if someone wants to buy out the whole company, hopefully they buy it out for more than what I actually purchased it for, right? And then there's those buyers, the people that are actually looking for acquisitions that are saying, hey, what are the cheap companies that we can go in and actually scoop them up and hopefully they're actually worth less than what their actual, tangible assets are worth. This was the cigar butt approach that Warren Buffett used to go after, finding companies that were below book value and just sort of getting that last puff out of them because they were worth more, if you were to just sell apart and just take care of the company that way. And so that's the sort of companies that he's going for. SoFi, sadly enough, has become one of those companies where it's so cheap that even if a company comes in and acquires it, it'll actually be a massive win for the people who are buying shares today. This is why I find reverse stock splits to just be so trivial, because the people who are buying the overall company or looking for acquisitions don't care how many outstanding shares are. All they care about is the market cap and the book values of the company to see if it's actually worth purchasing. And as long as you have that public market of people looking to acquire partial parts of the business and people that are looking to acquire all of the business, you're going to have a good fluctuating public market that gets to perfectly evaluate how much that company is worth. That's in the long term though, right? In the short term, there's a lot of voting going, a lot of investor sentiment, but it always gets tracked back to fundamentals because of the looming idea that someone could acquire everything. So look at this opportunity, even if there's a reverse stock split to buy, if the fundamentals are where you want them to be for the companies that you're purchasing, even if they're going to have reverse stock splits or even normal splits. These are just omens, right? There's just investor sentiment. They have nothing to do with the fundamentals, which always in the long term is what a stock will back onto. So as long as you continue to look at the fundamentals of the business and you believe that the company is undervalued, whether you're doing enough research or not, right? And you're actually looking at, okay, I wanted to buy this company because of, whether it's Galileo, Technesis, or I like the bank charter, or I like the fundamentals, or the book value is great, and you continue to like the reasons for why you bought the stock, just because the price of, the stock is going down shouldn't change any of those reasons for you, right? And everyone wants to point out like, oh my gosh, this stock is going down. What's wrong with, Anthony Noto? What's wrong with the stock-based compensation or something like this, right? The whole market is going down. Apple's going down. Tesla, is there something wrong with those companies? Like, why is it only your company that you own is why, you're blaming them for the reason why it's dropping? The whole market is dropping right now. We're seeing one of the worst drops in a half century. This is an absolute historical event that we're going through. Total macro problems right now, and we're blaming it on SoFi and Anthony Noto. For example, I was just looking back, and the first company that came to mind was Amazon, right? Back in 2000 to 2001, this stock has hit a massive rally and then continued to drop over 92% in a single year, okay? Which is just incredible. Although the company was actually doing good, its peers like Pets.com, Living.com, these sorts of companies had gone completely bankrupt. And so people thought, these websites were just going to go absolutely bust. That wasn't the case, right? And now hindsight gives us the benefit of looking at this company and seeing that if you would have held on, that 43 cents per share would have led you to, at one point at the highest, $183. Now that we're seeing the drop, $114, but still, I mean, from 43 cents up to $114 over 20 years. Just what an incredible return. But I mean, that's the benefit of looking at a stock from the long term. This back in the day is going to look like a blip, whether you bought it at $5 or you bought it at 40 cents, it's going to make no difference at $114. And investors back then were absolutely panicking. But Jeff Bezos was a smart, CEO at the time, and he wrote a letter to his shareholders, the same thing that he does every single year. I have it here, so let me bring it up. And I just highlighted a couple points that I thought were super important for SoFi investors of what we're going through today. Bezos said, "Ouch, it's been a brutal year for many in the capital markets and certainly for Amazon.com shareholders. As of this writing, our shares are down more than 80% from where I wrote from last year. Nevertheless, by almost any measure, Amazon.com, the company, is in a stronger position now than any time in its past." Sounds a lot like SoFi, right? Because we are in the best time that we've ever been in. The company's so strong, but the market sucks, and there's nothing we can do about that, right? But Jeff Bezos goes on to say more. So if the company is better positioned today than it was a year ago, why is the stock price much lower than it was a year ago? As the famed investor Benjamin Graham said, in the short term, the stock market is a voting machine. In the long term, it's a weighing machine. I say this all the time. Clearly, there's a lot of voting going on in the boom year of '99, and much less weighing. We're a company that wants to be weighed, and over time, we will be. Over the long term, all companies are. In the meantime, we have our heads down working to build a heavier and heavier company. Such a great line, right? So amazing. But whenever he actually goes on to here, I highlighted this, and now this doesn't actually, work for SoFi, but what he also talks about is that the market that he's in, computing power is getting a lot cheaper year over year, and that pretty much what he's saying is that the total addressable market is growing, and our processes are going to get cheaper over time. This is the exact same thing for SoFi because, digital banking is only getting more and more popular. People are getting more into their mobile apps, especially in Latin America, which we also operate. Technisys is based out of Latin America. That's where the majority of their actual, company is from. We are in all these sectors that are just growing from benefiting off of total addressable markets that are growing like crazy. Digital payments are becoming the norm, and SoFi is in the best position ever to take advantage of this growing total addressable market. But Jeff goes on to actually say this. He said, "I also added the 1997 letter. This was their first letter to shareholders. It gets more interesting every year that goes by, in part because so little has changed. I especially draw your attention to the section entitled, 'It's All About the Long Term.' Now, I've added this as well, okay? So this is the 1997 letter that he added, and this is the section that he's talking about specifically, okay? This is so interesting. Listen to this. Because of our emphasis on the long term, we may make decisions and weigh trade-offs differently than some other companies." He entitles some of the things that he thinks is different from other companies, but will actually be very, very apparent to how similar it is to SoFi, right? "We will continue to focus relentlessly on our customers." This is exactly how SoFi is offering the highest interest rates than any other bank, right? Or how they offer ETFs that are absolutely free, like zero management fees at all, is because we're putting the customers first. We want people to come to our platform first of all, and then we can figure out how to make ourselves profitable later, right? But let's just go back. "We'll continue to make investment decisions in light of long-term market leadership considerations rather than short-term profitability considerations or short-term Wall Street reactions." Like, is that not SoFi or what? I mean, we are worried about the long term, 5, 10, 20 years. We're not worried about quarter over quarter growth or, year over year, whether we're profitable or not. I know a lot of people on Wall Street want to make sure that we are profitable, but the truth is we have a lot of survivability. We've got a lot of cash on hand. We can survive for a very, very long time. Our burn rate is extremely slow. What's more important is the fact that we actually grow our overall user base while this market is new and fresh. We want to have hit the ground running here in this new area. Jeff also goes on to say, he says, "When focused to choosing between optimizing the appearance of our GAAP accounting and maximizing the present value of future cash flows, we'll always take the future cash flows." That's exactly the same thing as SoFi, right? We're not trying to make our balance sheet look pretty. We want the future growth of the company to be the ultimate successor, which, if you were to ask any investor, they would all say, absolutely, of course that's the greater mission. Making the company strong over the next 20 years is exactly what we want to do. But whenever actually faced with hard times in the markets, people react very differently than what they actually want or what they actually say they want. And, Jeff Bezos, obviously, hindsight's 2020. We know how this story ended out, but it was the better company for focusing on the long term. But listen to this next part, because honestly, this is the most mind-blowing part of this whole thing, and it's so much like it's on SoFi's ball. Listen to this. We will continue to focus on hiring and retaining versatile and talented employees and continue to weigh their compensation to stock options rather than cash. We know our success will be largely affected by our ability to attract and retain a motivated employee base, each of whom must think like and therefore must actually be an owner of the company. Oh my God. Like, isn't that exactly what SoFi is doing right now? Like, everyone's worried about the stock-based compensation. Same thing at Amazon, okay? That's the exact problem that they had, but they're not worried about it because they want people at the actual company to think like Anthony Noto, to feel like us, the actual, shareholders of the company, and say, what will you do for the benefit of the overall company and the stock price in the long term, considering you're going to be here for the next 5 to 10 years as an owner? So whenever you see all that, like, what's the difference between where SoFi is positioned today and where Amazon was positioned back in 2000? I mean, we have the growing total addressable market. We're in a very disruptible area right now where there's a whole bunch of legacy players like Walmart for Amazon, and we're taking it digital. Like we are in the exact same spot. The only difference is we have the hindsight of our hindsight is 2020 to know that over the next 20 years, Amazon absolutely goes booming and becomes one of the biggest companies ever. But SoFi could absolutely be in that same position. It's just people are feeling a little down right now because the stock is doing bad, even though the company is doing amazing. Like, look through the quarter, right? Does this look like a company that's failing? Does that look like a company that's failing? Galileo Accounts definitely doesn't look like it's failing. Lending, financials, our productivity loop, or even, our revenue going up every single quarter, and our EBITDA absolutely skyrocketing because it's some of the first quarters that we're seeing with our bank charter, right? So not only are we getting AWS of FinTech off the ground with Galileo and Technesis, and everything's just booming there, but also our bank charter is allowing to bring in the profitability and seeing massive jumps, like from Q1 to Q2. That's a massive difference now that we actually have a bank charter. And also student loans coming back on top of that. I mean, we are in the best point of this company, exact same way that Amazon was, but the whole market is down and people are just looking at, SoFi overall. Look at all the companies, look at the whole stock market. It's all down. I've said this before, right? All bad companies do reverse stock splits because it's their last ditch effort to just try something. They're grasping at straws to see maybe something will bring the stock back, okay? But not all reverse stock splits come from bad companies. There's a difference between, a company that's actually failing and can't hold on and, trying something because it's free and they can do it and might as well, hopefully it fixed the issue like a magic button, versus SoFi just trying to bring in new investors to a company that is growing. Certain ETFs and things like this, objectively, they cannot buy penny stocks. Penny stocks are companies that are below $5 a share. So we're either just, reducing the amount of companies that actually are allowed to buy our company, or, might as well just artificially inflate the number of, or reduce the number of shares that we have, which increases the price. It changes nothing fundamentally of the company, and so might as well, right? All I'm saying is that being afraid of a reverse stock split is a completely irrational fear, okay? The idea that someone can come in and acquire our company completely erases the idea that, this stock can just keep dropping just because, investor sentiment says so. I get comments all the time saying this stock is going to $2 a share. Well, let's actually imagine it, okay? SoFi at $2 a share would mean that the market cap is at $1.63 billion. Now, Bank of America looks at acquiring SoFi, sees 4 million users on our platform. They see Galileo and Technesis, which were both valued at $1.2 billion each whenever we acquired them. Maybe they've dropped even though all their accounts and everything have all, risen since then, but we're in a bad market. Then we look at our net book value, which is worth $5.5 billion. And no matter what, market we're in, it's worth $5.5 billion, and it grew 22% year over year. And so knowing they could acquire all that for $1.6 billion, you think anyone at Bank of America is saying, yeah, but you know what? They did a reverse stock split, so maybe we shouldn't acquire them. Yeah, right. That is absolutely false. If you think that, you're out of your mind.